Money Vikings. All right, Money Viking G here. I got a good one for you today. I wanted to go through a couple of reasons why the best strategy right now in terms of investing and wealth building for middle-class investors may very well be to do nothing, absolutely nothing. And I will explain reasons why that might be the best thing to do. Now, nothing about this channel is investment advice, so don't take it from me. We just share what we are doing and what's worked over the last 20 to 25 years in terms of wealth building and investing. So my basic premise is this. We are clearly living through some turbulent times, but the historical perspective that has to be kept in mind is that humans and investors have almost always lived through turbulent times. You know, there's some very interesting sort of work out there and research done. If you had bought, the equivalent of the S&P 500 index basically back in, if you'd held a broad basket of the stock market, 100 years ago or whatever, or 50 years ago, you would have lived and invested through just dozens and dozens of things that happened in the world that would have been perceived as the end of the world or the end of something or some big existential threat, right? World War I, World War II, the Great Depression, the Great Recession, Vietnam, 9/11, the housing bust, the stock market crash of the 1980s, the dot-com bust, the Greek debt crisis, the pandemic, the various epidemics and diseases of all kinds, the conflicts in the Middle East, Gaza and Israel fighting each other forever, Russia, Ukraine fighting each other forever, blah, 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 on and on and on, right? Tech disruptions, it goes on and on. And, there really seems to be no end in sight, because if you have humans and you have the way the world works in terms of its dynamism and the way things move and shape and unfold over time, there will be more and more changes and disruptions as humans live and as the world turns. The bottom line is then you have to keep that historical perspective in mind as an investor, not get freaked out. And now we're living through kind of a, some sort of reimagining of the economic world order, I guess. In some ways, you could say that there's the tariff war of 2025 is well underway. But I would just say this, things have a way of working themselves out. It sounds cliche, but it does happen. And what ends up happening is certain forces will go too far in one direction. They'll start to see the writing on the wall that it's not working, or it is working, or parts of it's working, and they change course and they correct. The bottom line, if you're a investor primarily in U.S. investments, is that the future of the U.S. is still very bright. The future of the U.S. is very bright for many, many reasons. Yes, the country goes through turmoil at times, like every country does, and it goes through different machinations and changes. But at the end of the day, the United States still has a good overall system. It has a strong, sort of organized system based on the rule of law. You have a system of capitalism with some guardrails. You have a social security system. Will all these things need to be tinkered with? Of course they will. You have a geography that is extremely valuable. You have a country protected by two large oceans. You have a country protected by two great allies. And you basically have an abundance of natural resources all over the place. There are tons of natural resources in the entire hemisphere and in the United States. So the bottom line is the future of the United States is still very bright. And I do believe that the future of the world will be bright, although we will go through rough patches as we typically do. So you have to keep that in mind as an investor. You don't want to make knee-jerk reactions when things are changing. Okay, here's the second reason that I'm talking about this in terms of the best thing to do would be to do nothing. Now, that is predicated on the assumption that you've been watching Money Vikings before and you have built a strategically diversified portfolio. I've talked a lot about this over the years. A strategically diversified portfolio has a couple of elements. Number one, it aligns with your values and your risk tolerance. Some people have a much larger capacity for risk. They can have a $500,000 portfolio, they can take on a bunch of risk, and if it drops 1 month to 400,000, they don't freak out. They just say that's part of the game, and they ride it out, and they go back up and get better returns in the future. Some people, the account is 500,000 and it goes down to 480 and they completely panic, okay? You have to know where your sort of set point is and how to manage it. If you're one of the people that panics, you definitely want to be in things that are more steady, less volatile, municipal bonds, CDs, treasuries, maybe some just sort of bread and butter blue chip dividend funds, right? Very straightforward. You're going to get that 4 to 5% return, and you're very happy with that because you don't get a lot of volatility. You just slowly go up the hill. Okay. Some people like to seek a little more. They like to have maybe some of that, but then maybe they like 20% of their portfolio to be in things that just swing for the fences. They want to be in things that are more volatile and have a potential to go up much higher. So if you build that strategic portfolio of diversified assets, then again, that's a big reason to do absolutely nothing. And you can see it in the wild swings, wild fluctuations. You can have the market down 1,000 points and up 1,000 points. Okay. So that's the second reason. The third and final reason is that making a lot of changes based on news is really just has not historically panned out for people with diversified investment portfolios. Because there's always going to be something in the news. So the news is meant to sell you advertising. That's the point of news in this country. It's not to inform you or to educate you. It's some of it is. There's probably a subset of it is, so I don't want to generalize. Maybe 25% of it is. But 75% of it is meant to get you to click and to watch so that advertising can be sold to you. So you have to realize you don't want to be making decisions based on advertisers selling images to you that will get you to buy their products. So you don't want to be making investment decisions based on that. You want to be making investment decisions based, again, on rational, strategic diversification over the long run. So those are big three reasons not to do anything. Again, I've still added some Bitcoin position. Bitcoin seems to be behaving the way it was supposed to, frankly, lately, which is very interesting. It seems to be rising as the overall market is having turbulence. So that's very interesting. We'll see how that continues to play out. But again, it was a quick one today. Thanks for watching. Check you on the next one. Please like and subscribe, all that great stuff, and check out truewealth.moneyvikings.com. All right, see y'all. Bye.